Well, some of the private banks are doing well. So ICICI Bank is picking up a little bit of pace. It's up around 0.5%. It's had a good week till now. It's up around 1.6% this week. Maruti is seeing a little bit of a comeback after yesterday's drubbing. So that stock is up around 0.5%. But no such luck for something like an Eicher Motors, which in fact is at around 20,665. Let's see how that pans out, considering the stock has lost around 10% on a week-to-date basis already after the disappointing numbers that it delivered for the month of December for the Royal Enfield space. But we do have Manisha joining in now to tell us what she's tracking in the commodity and the currency space. It's been weak for metals. Manisha's here to apprise us of the latest updates. Manisha.
Ekta, thank you so much for that. Well, yes, it hasn't started well for the commodity markets, for most asset classes for that matter. Overnight, you had to look at the US dollar index. The way it was declining, the dollar fell 3% versus Japanese yen at one point in time. So that impact, of course, has had, we've seen on other asset classes as well. Industrial metal prices have continued to decline. We saw 2 to 3% of a cut overnight markets there. The crude oil prices, which settled 2.5% higher overnight, have seen decline yet again. So we are 1 to 2% on the week side for many, for both those crude varieties there. It has to do with the volatile currency and the stock markets, the warnings of economic slowdown for 2019 that have been coming in from global analysts, etc. The global crude supplies have continued to increase, whether it's Russia or US. We have seen all-time high oil production for the month of December. While, of course, there are a few statements, we finally have seen Saudi Arabia cut exports in the month of December. There is positive statement coming from the Algeria oil minister as well. But it really has been the US-China war which has brought about a lot of negativity. The China slowdown. Remember, China is the biggest importer of crude in the world. And with the kind of numbers that we have seen come in from China, doesn't augur well. And that really seems to be really increasing the pain when it comes to many of these industrial commodities there. So apart from US and Russia, you also have to take a look at the Iraq numbers, where we have seen the output increase month-on-month basis to 3.77 million barrels per day as well. So there is increase in global supplies. Markets are yet to look at any demand upswing coming in, and with the kind of concerns that we are seeing in the currency space and stock markets, etc., it's something that doesn't augur well, especially for the crude oil prices. 1% down on your screens on that. Miswin Mahesh now joins us to talk more about that. Miswin, hi, Happy New Year. Has it really begun as a Happy New Year for the market bulls, though? Because the kind of slide that we have continued to see for the crude oil prices, what is your sense on where do you see now a floor forming?
Yeah, I think across the board, macro isn't looking that great, at least for now, for 2019, and until we hear more statements from central banks in terms of how they plan to, rehash monetary policy again. I've been saying this for a while. Systemic risk is pretty high. That's one of the key reasons, I'd say, in terms of oil as well. If you've noticed the last 2 to 3 weeks, it's been going lockstep with equities. If you draw the correlation with the S&P 500 and Brent crude, it's been pretty strong. And for oil to trade back in tandem with its fundamentals again, I'd say this correlation needs to break. For now, given the massive allocation of capital that's taking place globally from various asset classes, whether it be from bonds to equities, equities to commodities, because of those flows being much larger, that's part of the reason why, even with the Saudis trying to jawbone the market, trying to say they're cutting supplies, the reason oil's not really reacting to it. So I think we're in a market where macro is definitely at the forefront, and that's something we probably need to keep a close watch on if we're trading oil.
Well, absolutely. It really began with China yesterday, and then we saw a whole triple effect coming in with Taiwan, Malaysia, Korea, Singapore, most of the Asian economies reporting weak economic data, and then came Europe with weaker economic data. And then, of course, the US numbers were also on the weaker side, 15-month lows as we reacted to that too. What is your sense for the very near term then? Are we looking at further bearishness in the crude prices?
I think in the very near term, the direction will come from equity. So as I mentioned before, the correlation with the S&P 500 is very strong. Fundamentally, I don't think oil is sustainable at these levels in the long term. But then fundamentally, that's always the case, but for oil to trade back to that regime again would take some time. We need to remember that U.S. shale producers, some of them are realizing $35, $36 a barrel at the moment, whereas their average break-evens are between 45 and 55. That's not a good sign. So I'd say until that correlation breaks, oil may not trade back to that $60 per barrel level, which is what my target is fundamentally. We'll have to watch for that correlation to break. It will break over the next 1 to 2 months, and that will be the turning point. The other key thing, my final thing on oil at the moment is it's not as bearish, pure fundamentals, as it was in 08, 09, where we had ships storing oil. We had 40 to 50 ships that were storing oil. At that point, the contango was wide. None of that's taking place. Physical differential was strong. The only thing is there's massive flows of capital from one asset class to the other.
So while, of course, your target is $60 per barrel fundamentally, and with the near-term volatility that we are seeing, is there any expectation that we might see 40 before we see 60 again?
No, I think seeing 40 would imply WTI going to a much lower level.
Right.
I mean, even though in the very near term we could see prices dipping below 50 again, I'd say that's still a potential if the S&P 500 reach at 2,300 levels. But again, that correlation would be very, very, very actively watched, I'd say, at this point, given that's what market's trading.
All right, Ms. Vin. Thank you so much for joining us. So some more bearishness before we can start picking up on prices. All right,
Manisha, thanks very much for taking us through that particular conversation. We are going to stick with that theme about whether it's growth concerns at the margin which is leading to this kind of shifty sentiment, uneven sentiment across asset classes, be it oil, be it equities, etc. The incoming data, especially the PMI numbers from around the world, suggests that growth definitely seems to be slowing down. Marie Deron is Managing Director, Sovereign Risk Group at Moody's Investor Service, and she's with us right now on the phone line. Marie, thanks very much for your time. So, I mean, you've seen the numbers. The last number was from the US, the market PMI number, which is slowed down from November. We had numbers from China. We have numbers from a host of Asian countries which have seen a slowdown. What is it all pointing to in your assessment?
Yes, thank you for having me today. These high-frequency data, like the PMI, do point to a fairly broad-based slowdown in growth, and that is what we expect to become increasingly visible in the course of 2019. We expect that for the G20, that's about 80% of global GDP, we will see growth just under 3% from something like 3.3% last year. So that is a material slowdown that will manifest in various sectors, and probably first and foremost in manufacturing that tends to go through more pronounced cycles, and that's probably what is being flagged right now in these indicators.
Mary, what's your thought when it comes to probably US growth specifically? Any specific targets or estimates that you would be working with for 2019?
For the U.S., we expect GDP growth at 2.3% in 2019. To give you a benchmark, that's coming down from relatively high growth in 2018 at 2.9%. As during the course of last year, the tax cuts in particular were fostering growth. Now we expect these effects to wear off, and looking towards 2020, where then we expect a further slowdown towards 1.5%. GDP growth will adjust to less stimulative fiscal policy and also the monetary accommodation that is being withdrawn. In the U.S., like in the rest of the world, there will also be some impact of slower global trade, although the U.S. economy is less reliant on exports than some other economies, so these effects should be relatively smaller.
So you said G20 growth just under 3%, right? Versus 3.3%.
That's right. Yes, for the G20.
Yeah. Okay. So I mean, is that your assessment now, or I mean, is this the base case for you, Marie, at this point, or you think it could get worse? We have, Apple, for example, overnight, right? The US lowered their guidance, citing problems and slowdown in China. Actually, about 40% of S&P 500 companies' profits come from overseas, not just China, but from outside of the US. My question is, have we fully estimated how far this could go? The pullback in growth could go?
So this growth rate of just under 3% is our base case, what we at this stage think is most likely. And it does take into account, in general, that's less accommodative fiscal and monetary policy than we've seen in recent years, as well as some impact of the tensions between the U.S. and China that manifest in slower global trade. So that is part of our baseline. There are potentially further downside risks related to that, which comes from the fact that the slowdown is expected to be relatively broad. So we've talked about the U.S. We also expect slower growth in China at 6% this year, compared to 6.6% in 2018. In general, we expect slower growth in a range of emerging markets and Europe as well. So the spillover effects of that global, fairly broad-based slowdown could be more significant than we currently estimate. That would be one source of downside risks.
Okay. Mary, I just want to bring up China for, and the estimate that you're working with. You're expecting lower growth in China as well. But what is maybe an upside to the forecast, considering that China is stepping on the gas when it comes to, boosting the economy? So do you expect that to possibly show up maybe by Q3, Q4 in terms of the China growth figures? You expect it to probably pick up?
Indeed, we do expect that the authorities have already started and will continue to seek to support the economy. So that 6% forecast already includes some support from monetary and fiscal policy, but that is offset by the tensions with the U.S. and that will result in slower exports, as well as China's own policy, which remains focused to some extent on deleveraging and de-risking the economy, and the effects of that will continue to unfold during this year. So it is really a balance of factors there, of some stimulus to the economy, as well as some drag from trade and deleveraging. If the stimulus were to be larger, more significant than we currently expect, then yes, indeed, the growth outcome could be higher. That, for us, in terms of credit implications for China, could raise some renewed risks about less efficient investment and debt that would start to increase at a more rapid pace than we currently imagine.
Fair enough. Marie, thanks very much for shedding some light on what you make of the situation. So Marie pointing out that growth definitely is going to slow down, as has been sort of talked about now for the last couple of months. But data, for the first time, is now finally starting to point in that direction. And the extent of the eventual slowdown may actually be sharper than what is being estimated right now, according to Marie. Okay, so that is Moody's Investor Service and what they make of the situation there. We take a very quick break at this point. We'll come back. We have Market Technicals with Ashwini Gujral on the other side with his trading bets, and he'll take some other questions that you send us as well. Back in 2.